Imagine a world where dirty money could just flow freely, funding everything from terrorism to drug trafficking.
Yeah.
Pretty scary thought, right?
Definitely.
Well, today we're diving deep into the, fascinating but incredibly important world of anti-money laundering regulations.
Mm-hmm.
Specifically, we're looking at the UK's money laundering regulations of 2017.
Right.
And this deep dive, it's based directly on specific excerpts from the regulations themselves. So you get a direct look at the actual legal framework.
Yeah, no interpretation, just the source.
Exactly. Our mission here is to break down these, let's face it, pretty complex rules into clear, digestible insights.
So you can quickly grasp what's really significant.
Right, without getting bogged down.
And what's really compelling about these regulations, I think, is how they move beyond just reacting to crime. They're really designed to build a proactive, sort of risk-based defense system. And that impacts a huge range of businesses and professionals. It really shapes the foundation of financial security.
Precisely. It really underlines how these regulations are about proactively building a stronger financial ecosystem. So whether you're, prepping for a meeting, maybe you're just curious about financial security, or you just want to understand how the system keeps things clean.
Yeah.
This deep dive is designed to give you those aha moments.
Without the information overload.
Exactly. Okay, let's unpack this.
Let's do it.
So first off, why the 2017 regulations? These didn't just appear out of nowhere, did they?
No, not at all. They actually replaced the earlier 2007 rules.
Right.
And the main driver was bringing the UK in line with the EU's fourth money laundering directive.
Okay, and that directive itself?
That, in turn, was applying the latest international standards. These come from the Financial Action Task Force, or FATF.
FATF.
Right.
And people should think of FATF.
So it's the global standard setter. It's an intergovernmental body, and it really defines how countries should be tackling money laundering, terrorist financing, and, other threats to the financial system.
Got it. So it's part of a bigger international picture.
Exactly. Looking at that broader global context, these updates aren't just a UK thing. They really try more effectively, building on these internationally agreed upon standards.
A collective effort, really.
It really is, trying to raise the bar everywhere.
And the scope and reach here in the UK. Yeah, it's pretty extensive, isn't it? I read somewhere it's over 100,000 businesses.
That's the estimate, yeah. Over 100,000 businesses fall under this regime.
Oh.
But what's interesting, as you mentioned, is they aren't totally prescriptive.
Right. It's not just a checklist.
No. They're designed for flexibility. They promote this proportionate and hopefully effective risk-based approach.
And the thinking there is that the businesses themselves, they know their customers best.
That's the idea. They're best placed to know their customers and manage their specific risks.
Okay, so who exactly falls under this? You mentioned flexibility, but who are the main players?
Well, that's a critical distinction. The regulations primarily cover financial institutions, obviously.
Banks, lenders, yeah.
Right. And then what they call gatekeepers to the financial system.
Gatekeepers.
Accountants, auditors, legal advisors, tax advisors, those sorts of professions.
Okay. Did the 2017 rules change much about who's covered?
The core groups are similar, but there were some tweaks. For instance, the base level for general application, it actually increased.
Increased?
Yeah, from £64,000 turnover to £100,000.
Okay. Any other key changes in scope?
Well, Regulation 4 now explicitly states that if someone asks you to form a company for them.
Like setting up a new business.
Exactly. That activity itself is treated as starting a business relationship for the purposes of these rules, even if it's a one-off thing.
Interesting. So even single transactions can trigger it in that case.
Yes. And another significant one relates to high-value dealers.
People dealing in, like, expensive goods for cash, cars, art.
Precisely. Businesses accepting high-value cash payments for goods. They're still covered, but the threshold for what counts as a high-value transaction actually lowered.
Oh, okay. Lowered from what?
From 15,000 euros down to 10,000 euros.
10,000. Okay. So that brings more cash transactions into scope.
It does. And, this raises an important question. Why might lowering that cash threshold be such a critical detail here?
Yeah, that's a fantastic point. It seems counterintuitive maybe, but I guess the core insight is Cash is just harder to trace, right?
Fundamentally, yes. Far harder than digital payments.
So it's a prime route for money laundering. By lowering that threshold, the regulations just widen the net significantly.
Makes it tougher for even, let's say, smaller scale illicit cash flows to slip through unnoticed.
It really signals an increased vigilance, doesn't it? Pushing businesses to be more diligent, even at a lower value point for cash.
It definitely does.
And this idea, this risk-based approach, it feels like the backbone of the entire system, doesn't it?
It absolutely is.
But beyond the theory, what does that actually mean? For businesses on the ground, how does it work in practice?
Well, you can think of this approach operating at sort of three main levels.
Okay.
At the very top, the national level, you've got HM Treasury and the Home Office doing the oversight.
Right, the government bodies.
Then you have the supervisory authorities. These are the bodies overseeing specific sectors. Think accountancy bodies, legal regulators.
Okay, sector specific.
Exactly. And they have to conduct an assessment of risk across all the businesses they regulate and regularly review those risk profiles.
And the third level?
That's the individual enterprise level. So any business covered by the regulations has to make its own assessment of the likelihood of money laundering happening in their context.
Then they have to write it down.
Yes, keep a written record of the assessment and the steps taken based on it, unless they're specifically exempted, of course.
And when a business does that assessment, what are they supposed to be looking at?
Yeah.
Are there specific factors?
Yes. Regulation 18 lays these out quite clearly. They have to consider information they get from their supervisory authority.
Okay.
And then specific risk factors related to, well, several things.
Like?
Their customers, the countries or geographic areas they operate in, the products or services they offer, the kinds of transactions they handle, and even their delivery channels, like face-to-face versus online.
Wow, okay. So it's pretty comprehensive.
It really is. But the point is, this allows for different strategies. It depends on the business's size and nature.
Right.
It ensures that the policies, the controls, the procedures, they're proportionate. And they need to be regularly reviewed.
It's about tailoring the suit, not using a one-size-fits-all approach.
That's a perfect analogy, yes.
Okay, so you've assessed the risks, you understand your specific vulnerabilities. What do you actually do then? What about internal controls?
Right. The regulations are clear on this too. Relevant persons, so the business is covered where it's appropriate for their size and nature. They must appoint a money laundering compliance principal.
An MLCP.
Yes, the MLCP. And this needs to be someone senior, a board member or a senior manager who's responsible for the business's compliance with these regulations.
Is that different from the money laundering reporting officer, the MLRO? I've heard that term before.
It is distinct, yes. The MLRO is the person who assesses suspicious activity reports internally and then decides whether to report them externally to the National Crime Agency, the NCA.
Okay.
But the roles can be combined. If the MLCP is senior enough, they can also be the MLRO.
Makes sense. Less bureaucracy for some firms, maybe?
Potentially. And naturally, if you're a sole practitioner with no employees, you're exempt from needing a separate MLCP.
Right, that makes sense too. It sounds like a lot of responsibility, though, consolidated into those key roles.
It absolutely is. Requires specific expertise and oversight.
And beyond appointing specific people, what about like the wider staff? Employees?
Good point. There are rules around employee screening and training.
Screening? How so?
Businesses have to assess the skills, the knowledge, the conduct, and importantly, the integrity of any employees involved in, preventing or detecting money laundering.
So checking out the people on the front line.
Essentially, yes. And then there's training. All relevant employees must be made aware of the laws on money laundering, terrorist financing, and also data protection. That's key. And they need regular training on how to actually recognize and deal with suspicious activities if they see them.
And I bet they need to keep records of that training.
You bet correctly. Businesses must maintain a written record of all the training delivered.
These internal controls, they really feel like the frontline defense, don't they?
Absolutely. It's not just about having rules written down somewhere.
No.
It's about building a genuine culture of vigilance within the organization, empowering everyone to be part of that defense.
Yeah, culture seems key. Okay, so maybe the most hands-on part of these regulations for many businesses is customer due diligence, CDD.
Definitely one of the most visible parts.
This is really about knowing who you're dealing with, right?
That's the core of it, yes. When CDD is required, Regulation 28 sets out 3 mandatory steps.
Okay, what are they?
First, you have to identify the customer. Unless, of course, you already know them and have verified them previously.
Step 1, identify.
Step 2, Verify the customer's identity. Again, unless you've already done that, usually using reliable, independent documents or data.
Step 2, verify. Got it.
And step 3, assess the purpose and the intended nature of the business relationship or the transaction. Why are they doing this? What's it for?
Identify, verify, assess, purpose.
Okay. Those are the core steps.
And what if your customer isn't an individual? What if it's a company, a body corporate, as the regs call them?
Good question. There are specific requirements there. You need to obtain and verify the company's name.
Makes sense.
Its company number or other registration number.
Okay.
And the address of its registered office. Or, if it's different, its principal place of business.
So getting the official company details and checking them.
Exactly. But, and this links back to the risk-based approach, the regulations don't demand the exact same level of scrutiny for absolutely everyone.
Right. This is where the different levels come in.
Precisely. For situations deemed low risk, you can apply simplified due diligence or SDD.
SDD. Okay. And who qualifies for that?
Generally, customers like public administrations, publicly owned enterprises, maybe individuals residing in lower risk geographic areas, or credit and financial institutions that are already properly regulated themselves.
So entities that are generally considered less risky.
That's the idea. But then on the flip side, for high-risk situations, you have to step it up.
Right. And that's enhanced due diligence, EDD.
That's EDD, yes.
That's really interesting. So what actually triggers EDD? Is it just a gut feeling or?
Oh, no, it's not just a feeling.
Yeah.
The regulations list specific situations where EDD must be applied, no discretion.
Okay, like what?
Well, any situation where you assess there's a high risk of money laundering or terrorist financing based on your risk assessment.
Right. That makes sense.
Also, if your client is established in a country designated as a high-risk third country.
Okay, specific geographical risk.
Yes. Also, any dealings with politically exposed persons or PPs.
PPs.
Right.
People in prominent public functions.
Exactly. Their families, close associates too. And finally, EDD is mandatory in cases involving transactions that are, say, complex and unusually large, or where there's an unusual pattern of transactions.
Okay.
And crucially, where there's no apparent economic or legal purpose.
Sort of, this just looks weird transactions.
Basically, yes. If it doesn't make obvious business sense, you need to dig deeper with EDD. It feels like they've really tried to cover the main red flags there.
It does seem comprehensive.
And when you're assessing whether there is a high risk that requires EDD, even if it's not one of those mandatory triggers, relevant persons have to take into account several specific factors.
More factors, okay.
Yeah, and we can kind of categorize them for clarity. First, there are customer risk factors. Like, is the business relationship being conducted in unusual circumstances? Does the customer live in a high-risk geographic area? Are they trying to hold personal assets through complex legal structures like companies or trusts? Do they use nominee shareholders or bearer shares, which obscure ownership? Is their business very cash intensive? Or is the corporate structure just unusual or excessively complex for what they actually do?
Lots to consider just on the customer side.
Definitely. Then you have product, service, transaction, or delivery channel risk factors.
Sorry, the apples.
Things like private banking, which can be higher risk, products or services that favor anonymity, doing business non-face-to-face without proper safeguards, like robust electronic signatures, getting payments from unknown third parties, using new products or new technologies before the risks are fully understood, or providing services like nominee directors or setting up companies in third countries.
Okay, so the how and what of the business relationship.
Exactly. And finally, there are geographical risk factors.
We mentioned high-risk third countries, but is there more to it?
Yes. It includes any countries identified by credible sources, like FATF, as having ineffective anti-money laundering or counter-terrorist financing systems.
Okay.
Or countries known for high levels of corruption or other criminal activity. Or simply countries subject to sanctions or embargoes.
So you have to really be aware of the global landscape.
You absolutely do.
So let's say you've identified EDD is needed, either because it's mandatory or your risk assessment points that way. What specific extra steps must you take then?
Okay, if EDD is required, the regulations say you must do at least two things.
Right.
First, you need to understand, as far as is reasonable possible, the background and the purpose of the transaction. Really dig into the why.
Get the story behind it.
Yes. And second, you must increase the degree and the nature of monitoring of that business relationship.
So watch it more closely.
Essentially, yes. Watch it more closely to determine whether ongoing transactions or activities seem suspicious.
Okay. Identify, verify, assess purpose for standard CDD, and then dig deeper and monitor more closely for EDD.
That's a good summary.
All right. Now, beyond doing the CDD yourself, are there rules about relying on others or about keeping records?
Yes, to both. First, reliance. A relevant person can rely on a third party to carry out those CDD steps we just discussed.
Oh, okay. So you could outsource it.
You can. But, and this is crucial, the relevant person in your business remains liable for any failures by that third party.
Ah, so the buck still stops with you.
Absolutely. Which, raises an important question. What's the real implication of that continued liability for a business choosing to rely on someone else?
Yeah, that is indeed a huge point. It means, I guess, while you might outsource the process of doing the checks, you can never truly outsource the responsibility.
Exactly.
So the implication for businesses must be a critical need for really rigorous oversight of those third-party providers. You have to make sure their standards are as robust as your own would be.
Precisely. It's a powerful message. You are ultimately accountable.
And that ties directly into why keeping meticulous records, which you also mentioned, becomes so important, right?
Absolutely non-negotiable. All CDD documents, copies of verification evidence, information about the business relationship, transaction records.
How long do you have to keep them?
For a period of 5 years after the business relationship ends or 5 years after the date of a one-off transaction.
5 years, okay. It's about having that clear paper trail, or digital trail, I suppose.
Essential for demonstrating compliance if asked, and crucial for tracing activity if something suspicious does come up later.
Right, okay, so we have the rules, the assessments, the controls, the due diligence, the record keeping. Finally, what happens if these rules aren't followed? Who actually ensures compliance? Who enforces this?
Well, Part 8 of the regulations gives the supervisory authorities, those sector-specific bodies we talked about, the powers they need to monitor the businesses they oversee effectively.
Okay, so they watch over their members.
Yes, and Part 9 empowers them to take appropriate action if they find breaches.
Action like what?
Things like imposing civil penalties, monetary fines, or issuing public statements naming the non-compliant firm. It's about ensuring there are real consequences.
So there are teeth to these regulations.
There are meant to be, yes.
And I think you mentioned something earlier. There's another layer of oversight now, too. Something called OPBAS.
Oh, yes. OPBAS, the Office for Professional Body Anti-Money Laundering Supervision.
That's a mouthful.
It is. But it's important. It's actually a regulatory body that sits within the Financial Conduct Authority, the FCA.
Okay. And what does OPBAS do? Does it supervise individual businesses?
No, not directly. What's particularly insightful here is OPBAS's role is to supervise the supervisors.
Ah, okay. Supervising the professional bodies themselves.
Exactly. OPBAS ensures that those professional body anti-money laundering supervisors, like the accountancy bodies, the legal societies, are meeting the standards required by the regulations and how they oversee their members.
I see. So it adds a layer of quality control on the supervisors.
Precisely. And it also aims to facilitate collaboration and information sharing between those supervisors and law enforcement agencies.
It sounds like a crucial mechanism for making sure the whole system, including the supervisors, is actually up to snuff.
It adds a really robust layer of accountability to the entire framework.
Okay. Well, there you have it. Quite a journey through the UK's money laundering regulations of 2017.
It's a lot to cover.
It really is.
Yeah.
We've gone from their global origins, connecting them to FATF and international standards, right down to the nitty-gritty details of risk assessment.
The 3 levels.
The importance of internal controls, like having that MLCP.
Yeah.
The crucial steps of customer due diligence, from the simplified STD to the more intensive EDD.
Right.
And finally, touching on reliance, record keeping, and the oversight mechanisms like the supervisors and OPBAS that ensure compliance.
It is a truly comprehensive system, designed ultimately to keep our financial world safer and cleaner.
It really is.
Stepping back to consider the broader implications, these regulations, they represent this constant, evolving battle against financial crime.
Yeah, it never really stops, does it?
No. And they really highlight this intricate balance that has to be struck between preventing illicit activities on one hand and ensuring that legitimate businesses can still operate effectively and efficiently on the other.
That's a tough balance to get right.
It really is. And it makes me think, It raises an important question for the future, perhaps. Given how detailed and adaptive these regulations try to be, how might the rapid evolution of technology, things like AI, crypto, digital identities, how might that continue to challenge and reshape this fight against money laundering in the years to come?
That is definitely something to mull over as you go about your day. Technology is both a tool for launderers and maybe a tool for detection.
Exactly, a double-edged sword.
Well, we hope this deep dive has given you a clearer picture of how this crucial part of the financial system works to protect itself, and really all of us.
Hopefully some aha moments in there.
Hopefully. Until next time, keep that curiosity alive.